Welcome to the Off-Chain Podcast. Don Redden here with you, and my co-host for this episode is Yaroslav Writtle. He is a partner at Faculty Group, and in this episode, we're going to be talking about things like what makes a startup succeed or fail, what are some of the key principles for building in Web3 in 2023, the importance of narrative, and how you can masterfully create one for your enterprise, trends for investing in the bear market and building in the bear market, and heaps more. So I hope you enjoyed this conversation with Yaroslav Writtle. Good to be able to connect with you in this kind of capacity. How are you doing today?
Very well, thank you, Don. Great to be here.
And where in the world are we talking with you from at the moment?
We are in a not so sunny, very dark London today.
So London, cold?
Cold, freezing. We're
Yeah.
expecting snow next week.
Okay.
So we're trying to stay warm. As a Russian, we're used to it. So this is, rolling with the punches.
Well, it's kind of the opposite here. If you see beads of sweat start, it's not because I'm obviously nervous to be chatting with you, but because it's 40 degrees outside here. So, slightly uncomfortable, but for very different reasons for where you are. So, Yaro, how long have you been in the Web3 space, or let's say even the fintech space more generally?
Yeah. I mean, fintech for a long time. I mean, for 7 years or so, I was previously in the kind of management consulting exec search space, very much specializing in professional services, banks, and fintechs. So really working, sort of C minus one. So if a bank wanted to build a fintech sandbox, or a big four company wanted to acquire a digital fintech or a digital consulting firm, we tended to specialize in doing either M&A for that or actual search for partners to do that. And then crypto really came around in 2017 when a very good friend of mine and now also co-founder of Faculty Group, Mike, called me one wonderful day and said, hey, take some money and put it into Ethereum. This was, I think, February 2017. And at this point, I had absolutely no idea what blockchain was, what Bitcoin was, any of it was. But he was very good. A friend of mine who knew space, so I thought, why not? Let's try it.
What was the price at that time?
It was about 114, if I remember correctly. It was 114, 120. I remember kind of buying it in two chunks via Kraken, I think, of all places. That was my foray into it. And then of course, price goes up, interest goes up at the same time. You think you're an absolute genius, and you start investing into ICOs and start looking at all these weird and wonderful companies out there. And soon you start realizing that some of the stuff doesn't really make sense and seems to be defying the laws of gravity quite severely. And so really started geeking out on token economics and how do you actually build tokens that don't just aren't used as a fundraising mechanism, but actually do something useful. And I think back in and off the back of that, I went into a company called Symbol Network, where we really specialized in doing token economics and actually creating token economics for projects. And this was sort of in the midst of 2018 at this point. And of course, there was a big crash. And when Bitcoin goes down, a lot of people don't really want to pay 50 grand for a white paper of how tokens should work. They are, struggling for air. So, but that was really kind of first foray into crypto.
Yeah, right. And so coming through basically, finance, technology, HR recruitment, M&A, that kind of stuff. I'd love to talk with you more about M&A as well, maybe in a minute, because I was in a conversation recently where we were saying, where are all the M&A experts in crypto, and why don't you see M&A like you do in, say, Silicon Valley or traditional finance and that kind of stuff. But anyway, back to your story. You saw Ethereum, a mate tells you, hey, check it out. You start to make some money, start to notice some of the gaps, start to try to fill some of the gaps. How do you feel that tokenomics has actually developed or grown over the last 6 years or so since you've been around tokenomics specifically? Because you're right, it's a massive, massive area.
It's a massive area and it's evolved a lot. But I think one of the, back in 2017, 2018, there were some very basic economic models where the common narrative was my token is a currency to power my ecosystem, right? And I think that phrase We saw it so much back then. We see it a lot even now to some degree. And I don't think there was a lot of maturity between separating. We knew there were security tokens, and those were a narrative that really developed. There was a utility token, which 99.9% of tokens fell into, and and I don't think governance tokens even existed back then, if I remember correctly. So the concepts of DAOs weren't really, if they existed, they weren't popular at all. And so I think even if we fast forward to today, there's the whole field has evolved massively, and it's something that we have seen lots of new token models. There's a realization that a token can be a capital asset, can be seen as a commodity, can be seen as security, can be seen as a currency, and often those aren't mutually exclusive. So they do share lots of those traits. And so the field of token economics, is still very poorly understood. And I think a lot of people think token economics is token metrics, i.e., how long does a token vest for? What's the cliff? And often, there is a misunderstanding that actually this is more around how does a token capture value, both as it create value and then accrue value back to the token. And if you double click into that, you've got, of course, NFTs versus fungible tokens. And I think sometimes we've seen fungible tokens being used incorrectly, in that they are primarily a way to, govern decentralized networks in a trustless way, in the simplest form. And often I think we've seen fungible tokens used, not them in the most appropriate ways of raising non-dilutive capital and adding 20, 30 million to a balance sheet in the form of a token sale that fundamentally accrues back to equity investors, and without actually having any accrual mechanisms going back to the token. So I think the mechanisms and thinking and the level of sophistication has certainly improved since the last 2018. But at the same time, looking at where we are today, we're still repeating a lot of the same mistakes that we had back then. And I think there's certainly some room to go before that gets fixed.
Yeah, I remember back in the kind of ICO boom days where people or projects, for example, the primary reason for having a token was purely for fundraising, and it was a pseudo security, or it was just an outright security, except that you had no equity in the actual company. So there were no rights conferred. There was only the hope of the pumponomics, or the I guess again the hope that because of increasing demand and the fact that the supply wouldn't necessarily increase, although that didn't always hold out to be true, that there may be some increase in the price of the token. And fast forward to today, and some people are still stuck in that kind of mindset. But on the whole, my hope is, like you're saying, that the industry has matured and grown, and people are actually taking it more seriously. And even some projects not releasing a token at all and going back to a more traditional kind of VC model of fundraising via equity and regular rounds, like doing a seed round and a Series A, Series B, that kind of stuff. In what kinds of ways are you still seeing maybe the hangover of the ICO boom in the way that people are approaching using a token?
Yeah, I mean, the what you mentioned around using the tokens as purely a fundraising mechanism that still exists today in business models, which it makes absolutely zero sense in. But as I said, you're just raising undiluted capital. We're still seeing a common mistake of what is termed kind of token velocity, which is around, hey Don, I'm going to be using your ecosystem, and for me to pay for access to your ecosystem, I need to pay you in your native token. So I'll take $10 worth of $10 actual USD. I'll go buy $10 worth of your native token. I give it to you for the access to that good or service. You take that, take it to your treasury. Hey, but guess what? You're going to have to go and sell the majority of that to pay your staff, pay for office space, for all these things. And so you've had a transaction take place, but essentially the effect of me purchasing and you selling is close to net zero. And so you see this kind of issue where the MAU and the traction in the network might be going up from a fundamentals perspective, but the metrics around the token don't quite keep up, unless there's been some very clear kind of token sinks and token sources can identified. And what we've seen, in a bull market, this is hidden. And you don't really see the wood from the trees because it's very, as we know, the market is very sentiment driven. So you see a lot of hype. You have partnership announcements. You have some kind of big influencers coming in and promoting a project. And so people are buying into the fact that this is going to do well, so I will buy now. Whereas, of course, when you come into the bear market, the tide goes out, and
Yeah.
a lot of that hype is no longer there, right? And so the project has to stand on its own 2 feet from a fundamental perspective, and that's when you start really seeing, how many tokens and the price of tokens were propped up by just pure hype and speculation from the market and the retail crowd, and how much of it is actual kind of buy back and burn, or actual value accrual from fundamental metrics.
Yeah, and it damages the projects that have done tokenomics well as well, because as the market kind of cleans out those projects that have just relied on kind of the pumponomics and whatnot, the projects that actually have a well-established and nuanced token economy, they're dragged down as well. So it's kind of it's defeating the market a little bit by having these projects that have not thought through the tokenomics.
But it's also an opportunity, right? I think this is one of the opportunities from a kind of putting the VC hat on to some degree. Is you now have concepts which is kind of more akin to price to earnings ratios that you didn't have back in 2017 because there were so few products available. If you look at Ethereum, you can start looking at kind of price to earnings, or fee to price ratios, right, which are kind of similar models. And so you can actually start looking at profitable protocols. And again, a big theme right now is what's real yield. If you look at the DYDXs, you look at Ethereum, you look at a lot of the DeFi protocols that are genuinely or DEXs that are generally generating fees, and those fees are accruing back to the token, which is a big if, an important one, because like Uniswap, for instance, fees are happening, they're not accruing back to the token yet, and so there's an element of expectation for that. So given that the market is still immature in pricing some of these assets and is still sentiment driven, just like you have assets which are overbought and overvalued in a bull market, you have a lot of assets which are oversold and are a real value buy in a bear market. And if you look at just a lot of the fundamentals around the team, around the project, around the fees, the product market fit, and some of these more, let's call them traditional Web3 metrics, we now move very much from momentum investing, which is kind of the schema for, let's say, a bull market where you're looking at who else invested, is Binance back in this ABC, to actually looking more value investing, which is actually where is the most value to be had. And sometimes it's not about getting to seed or private sales. That's actually seeing some of the value on the open market and then dollar cost averaging into those positions.
Yeah, right. So coming out of the kind of growth phase and momentum investing has also been pretty devastating, as again, Silicon Valley or traditional markets are revaluing basically all of the companies. That's kind of happening in a Web3 environment as well, but because they've been incredibly inflated and many of them have no revenue. So to actually try to do a PEG or a PE, you can't do it because there actually are no earnings, or the earnings are so inconsequential or so minimal that it would be devastating to try to value a company based on their earnings. In terms of the market, is this the future until the next bull? Will it flip back the next bull, or is this the standard kind of way of viewing and pricing companies now in the Web3 space? My hope is that it is, because it's a much more valid way. Like I said, it's much easier to be an investor or to run a venture capital firm, or to be a regular investor, trying to be in the retail market, but less money perhaps to be made, or more smart money to be made. How does it work?
Do you know what? I love the saying, history doesn't repeat, but it rhymes.
Yeah.
I just, I think, and I can personally speak for myself, I don't trade because I suck at it.
Yeah.
It creates a lot of stress, and I'm just terrible at selling or buying, right? And this is why I know that my the thing I'm better at is looking at the value buys and just buying holds and then dollar cost average and add to my position for things I believe in. Why do I say this? Is because, I think I think everyone deep down knows what is good and what is bad, but the emotions, the FOMO, the fear, the greed kick in.
Yeah.
And, I speak for myself. There have been so many times when you invest in a project and it does a 2x, then it does a 5x. And you think, should I take some profit? No, it might go higher. Then it does a 10x. You're thinking, well, the other project did 100x. So, I'll be losing out. And this the take profit mentally is keep going up and up and up and up.
Yeah.
And unless you have very strict trading disciplines, which I think, again, very few people have, and even those that have, even fewer implement them, it becomes very difficult. So, in terms of, will the market mature and become better at pricing, which will reduce the kind of the peaks and trough of the valuations? Sure, I'm absolutely, I believe that will happen, as happens in any maturing market.
Yeah.
As we become more sophisticated in using different ways to value projects, as we become have a bigger data set to draw comparisons of. But will we ever get rid of that fear and greed emotions that kind of really influence trading? I don't think we will. And if you look at even today, you look at projects, again, I haven't checked the recent market price, but chains like Aptos, project value is over $10 billion market cap, fully diluted valuation. On what basis? And you look at some of these projects, and things don't make sense. And I think the market will start trusting the fact that everything will revert back to the mean eventually, whether something is completely overpriced or completely underpriced. And I think that's where we'll get to. But it won't be, the behaviors and the traits that we've seen in the past, cycles will continue. They'll just become more muted.
Yeah, gotcha. It's funny. When I first got started in crypto, it was early on. I thought I was a great trader because came in at 2017 when everything was going up, and like you, also very, very rarely, if even never, I'd say never trade really. But I was waiting for that mean reversion on Ethereum as I saw it go from $7 to $22 to $40. I was thinking, okay, everything reverts to the mean. I'll just wait for it to come back.
Yeah.
And then finally FOMO'd in at $400, basically clipping the top of that peak. And thankfully dollar cost averaged, on the rest of the way. But yeah, I mean, it is amazing. Exactly as you say, some of the valuations are both astronomical and stupid actually at the moment. And so, surely either some of those will just explode spectacularly downward, or just as the market kind of finds its mind or matures, maybe it's a better way of putting it, those valuations become much more appropriate, let's say. All right, so
One would hope. Eventually.
You are the COO of Faculty Group. And basically, COO means you run the place, but the CEO gets all the credit. What have you found in building a company through both bull markets? Let's call it a builder's market, a bull market, and then a bear market again. How have you found it different? What have you found really important? How have you found your background in HR and building helpful? And what does it look like in the current season for faculty and for you personally?
Yeah. I mean, the first thing to say is, I think when you're in crypto, everything moves at what feels like 10x the pace, and you're basically drinking from a fire hose, is what it feels like.
Yeah.
Especially in the bull market, because there is just so much opportunity cost, and you're just having to make decisions very, very quickly. Look, I think the building a business within crypto is not that different to building in the real world, and that first of all, you're going to make a ton of mistakes. I've made a huge number of mistakes in the last several years, and will continue to do so. And hopefully not repeat the same ones. That's the biggest aspiration. With the way that faculty has grown, again, I joined I joined the business when the 5 founders were of course there, and they kind of kicked things off and had a huge success. And I joined the business. I think we were just under sort of 15, 20 people at the time in total. So there were about sort of sub 10 people in the core business and a further sort of 10 in the marketing business. And that's just grown astronomically in the last 2.5 years, 3 years, to I think over 115 people that we are today. And that with it, in that growth, it's brought its own growth pains, and we've kind of been building the plane as we're flying it in place of the bull market. And there's been two aspects. One is growing the business in a different functional perspective. So before, if you had everyone focused on one or two core projects and working together, as you know now, we've got the venture capital business, we've got the incubation business, we've got the kind of corporate ventures arm looking to service kind of Web 2 to Web 3 transitions. We've got the marketing business, we've got the market making business, and then we've got Faculty Studio, and of course Taurus as the innovation hub. And so there are a lot of moving parts, a lot of different business models, and a lot of different types of businesses, some which are more annuity-based business, service-based businesses, which are easier to forecast, to model and adjust, and some which require significant capex before they yield a dividend. And you're having to kind of arbitrage the capital requirements between those different ones and make sure that you don't land flat on your face in the midst of scaling up and don't run out of money. So that's been the first aspect of really kind of grappling with different business models and making sure that we're scaling those in the right way and trying to assign the right resources to those. And on the flip side, it's just more the people side. Again, it was a very founder-led business. In some requests, in many respects, remains to be so. But really transitioning to a more decentralized model where you're creating separate business units with separate P&Ls, with more autonomy and more freedom to operate, to make decisions, make mistakes, make successes, but fundamentally, stand on their own 2 feet whilst being supported by the center. And creating the structures, the communication, the support, the incentives, the training, everything around that, has been kind of a key transition to building something that's more agile, building something that is more autonomous and isn't bottlenecked by essentially a small number of people in the middle. So that's been a real, real journey to doing that. And looking back to your earlier question, we're looking back, how was my previous experience to help with this? I think a lot of what I was doing in my previous company was answering the question, how do we solve growth with people? And whether that is about looking to hire a senior person with a team into a position to address a specific problem, whether it's a restructure, a turnaround, or a build, or whether it's looking to acquire a small company to build out that capability, natively. And a lot of that is around people due diligence and making sure you have the right people in the right positions with the right cultural fit. And so I think, my approach to this, I'm not saying it's to being the right one, but it's also been where, my background served to this is really focusing on the people side. So how do we help have the right people in the right positions, play to their strengths, and then what support structures we need to put around them to make sure that happens. So I'd say those have been the some key takeaways.
Yeah, for sure. It's funny. Man, people due diligence is still such an underrated part of company building, even investing. Like we at Ataris, we were working with one company where the team was amazing, but the product was average. And so we thought, man, we'll try to help them along the way. But that project eventually folded. It wasn't great. But the team moved on to something else, which was better, but still not amazing. And so we worked with them because the people are amazing. And that pivoted into something that is looking really amazing, actually. And if we hadn't persevered because we had done the people due diligence up front, even though the company originally, the original project wasn't so great, we wouldn't have ended up with this thing eventually, which is looking incredibly promising. How possibly is people due diligence still so underrated when it is the bedrock of HR. So if you're hiring internally, obviously you want to make sure people have a great culture fit, great chemistry fit, that they're competent, they can do their job, those kinds of things. And yet when we look at investing, not for faculty group, obviously, faculty capital, doing their people due diligence, but in the market, people still following the big hype and not doing that due diligence. How are we missing it, and how is it better done, do you think?
Because it's hard, I suppose, in the word. And this is the thing. Even when you're, when you're doing executive search, so let's imagine we're looking to hire a CXO for a new bank or a big venture, an entity. There's a lot of work that goes into that in terms of, you realize that if you're hiring the next chief technology officer for HSBC, there's only a few people in the world that can really do the job at that scale. And so before you approach that person, there's a lot of referencing done around who is the best person, what have they done before you even approach them. And then, of course, there's a lot of vetting throughout the process, whether it's psychometric interviews, where it's going through, the kind of the three pillars of, are they capable, are they motivated, and are they coachable, right? Really, and around those pillars. And so when you're doing this in the kind of the Web 2 world more, there's a lot of this due diligence that you do, which does take time. And even then, there are certainly no guarantees, because someone might be great on paper, might have great references and be a great interviewing, but when the rubber hits the road actually doing things, they may not work out. And so you can only minimize that risk, but you certainly can't mitigate it entirely. I think when we look at it in the crypto world, I mean, several challenges. The first is that the space moves so quickly that I think there is almost an effect of, well, we don't want to miss out, so let's give this a go with someone. The second aspect to that is also is very few people who have maybe really done this for a long time, because the space is so new. So it's not a case of, hey, I want to hire a person who's been a CTO at a bank, for 20 years on a hire into another CTO role for another bank to do exactly the same role with a slight tweak to it. What you're looking for are transferable skills. So someone who maybe has done something in a similar field, has demonstrated the right track record, has demonstrated the coachability, which again is such an important trait. I think is often often missed, and demonstrates this transferability and hunger to learn. Because, and as I'm sure you've seen yourself, we're in a space where what you knew 6 months ago is almost irrelevant today, and you're having to kind of relearn everything from the ground up, and you can't rest on your laurels of past experience. So I think, finding people who are hungry, who are curious, who are competent, who can bring that corporate experience into a startup mentality, is very challenging. So I think that's probably that's probably why it's very difficult to to really kind of get under the core of it.
Okay, so no solution other than doing the hard work, really.
I think the if we make it actionable, I think when we look at either portcos or hiring for ourselves, first of all, having a very clear scorecard around what you're looking for. And again, I like to think of it in 4 buckets, which is functional experience, domain knowledge, soft skills or cultural, and then the motivation side. So you're looking at, if you're hiring a salesperson, can they sell? Have they done it before? Domain knowledge is around, okay, have they done it in the crypto space? Have they done it in, a SpaceX that you're trying to get them to? Culture is, will they gel with the team? What is their leadership style? Have they led decentralized remote teams versus, something physical? And the motivation is, why will they keep going when the going gets tough? And so I think if you start assessing people through that framework, the second way to approach it is then getting people started on an interim basis, on a part-time basis, and seeing how they do in practice. And so let's say you start them off with a 1, 2, 3 month trial period, see how they do. And then, that should almost always be a very good indicator of how things will continue. And when you're talking about portcos and investing, again, having conversations not just with the CEO that you're looking to invest into, but also having conversations with their team to see what is the relationship they have with the CEO, what is the management style, and why is it they stick with this person or follow this person. And I think to your point again, there's often very strong teams with not a very good idea. And, there have been multiple occasions where I personally have invested into angel rounds like a long time ago, just purely based on the person rather than what they're building.
So if you're giving, say, advice to a startup founder right now, and they're looking at recruiting, would you recommend them doing that recruiting themselves, using a recruitment firm or agency or person or headhunter, or what's your like skilling up in the recruitment process themselves? What's the general, like generic advice, non-specific advice?
Yeah. I think the best hiring is always done through your network and recommendations. That's typically where the best people come from, because the best candidate will not always be the best candidate on paper. Personally, and this might sound somewhat controversial in that, having come from that background, but recruiters will be probably my last resort.
Okay.
Because once you've exhausted your network and once you've exhausted those recommendations, this is when you get to the recruiter side, because the risk of making the wrong hire increases because you're hiring based on someone's CV and their interview ability rather than
Right.
their previous experience of having someone you trust worked with that person before.
Yeah, gotcha. Any other kinds of lessons from our Portco companies or from your experience in terms of building Web3 or successful Web3 companies? What else are we looking for or finding?
Yeah. I look for. I mean, a lot of this, a lot of the things that apply to Web3 companies is exactly what applied to Web2 companies back in the day.
So it's just
So
building
I
companies.
would. It's a case of like, just I suppose one of the most common things, or things I'd like to see more, is just the lean startup approach to building a company. Having this kind of build, measure, learn loop. So, often we see, and I would call out layer ones probably as the biggest culprits in this, or GameFi is another one, where there is a solution in search of a problem, and you're just building something that was an academic exercise that you're able to raise capital for and is then built, and then you're trying to figure out what is product market fit. Well, often, if you're building a solution, you've built a solution and then looking for a problem, you're going to realize that you're going to run into problems very, very quickly. So, but follow that problem solution set. Just trust, test it in the market. Make it, is this needed? Is this viable? If I'm going to be, if I'm building a layer one, how am I going to differentiate from the 25 other blockchains out there? Like, why am I different? So that's the first thing. So focus on, product market fit. Secondly, know your audience. We've seen when you're building companies or startups, you should be going out there and talking to your end client every single day to understand what are their pain points, what are they looking for, what are they prioritizing, what are they willing to pay for, and what's going to make them stick around. And I don't, we have the term build a community in crypto banded around a lot, which basically is measured by how many people do you have on Telegram or Discord or Twitter followers. And often, who are these people? Is this mercenary capital because because you're giving away free money, or because you're doing some big airdrop, or are the people who are genuinely interested in your product? And again, we talk about things like vanity metrics versus actionable metrics. Vanity metrics would be around, okay, well, what is the amount of total volume on my network or total, wallets? But then, we'll use Optimism as an example. Optimism launched that Quest program, if you remember them when they launched. And they had the Quest, and the amount of volume, obviously Optimism skyrocketed in that time. But as soon as the Quest program finished, the volume dropped by nearly 80%. So you can see that 80% of that, of that audience was basically what we call mercenary capitals. They're there for the rewards, for the airdrops, for the token. And those that stayed were going to be true users, which is the same comparable to, who are the users that convert from being in a free trial and convert to actually being paid users, right? In the Web2 space. So I think I'd love, when we talking to projects and talking to startups, when we talk about what is your traction, what is your product market fit, what's your validation of your problem solution set, I often look for not just the vanity metrics of we've done this and some big partnership there or here or everywhere, but specifically who is actually using your product and who's paying for your product outside of the ludicrous incentives that we tend to see in the space, either through liquidity mining or airdrops or you name it. So I think that's a big thing to focus on.
Yeah, right. So if the problem is, or the fake solution is a solution in search of a problem, what do you think are some of the problems in not just Web3, but in general that blockchain companies, crypto startups, Web3 innovators should be looking at this year? What are you looking at, and what are you hoping? What
Hmm.
problems are you hoping are solved this year? At the macro level, at the micro level, what are you looking for?
Yeah. Um, there's a very interesting, and one of the really interesting aspects for me is this kind of Web 2.5 space. I think we've seen a lot of big traditional brands like Nike, Porsche, Dolce Gabbana. I think it's about 52 brands out of the Fortune 500 have dipped their toe in the water when it comes to NFTs. And we've seen a lot of these companies do. Some have been very successful. Nike generated, I think, $189 million in incremental revenue last year from their Web3
Pretty good.
engagements. Whereas others have not done so well. I think the Porsche campaign, I think they sold about 20 or 30% of the NFTs they're looking to drop. And that's
Yeah.
because the Porsche audience does not know what NFTs are, let alone, how to interact with the blockchain, which speaks back to our knowing audience. So what I'd love to see is, there is definitely mechanisms to use Web3 strategies to have better audience engagement. And that has been demonstrated very clearly, to create loyalty programs. And Deloitte wrote a very interesting white paper about loyalty in Web3, looking to increase conversions, looking to turn your customers from passive buyers of your products to raving evangelists of it, and actually segmenting the Kevin Kelly quote of your 1,000 raving fans. Who are your 1,000 raving fans, and how do we reward them, how do we engage them, and how do we empower them to spread the word and evangelize what you're doing? So there are a lot of great companies in this space who are doing great work in bridging that gap, but and providing the tools. But what I would certainly love to see is more companies, and again, we're doing more of this ourselves now, and this is kind of one of the arms of faculty, is doing more around bringing those different jigsaw pieces together to enable those brands to do a POC of this is what good looks like, and then scale it out across the larger parts. So that's kind of the first part. I think is going to be really interesting, and we'll see more progress and more investment into over the next few years as we kind of look to bridge that gap between Web 2 and Web 3. I think the other dimension, we saw the kind of implosion of CeFi, for lack of a better word, last year. From through
Yeah.
Arrows and Celsius, and these, of course, Luna, the darlings of 2021. And thinking, how the hell did they grow so quickly?
Yeah.
Well, I've got an answer for you. They over leveraged and they overspent, and it just did some rather dubious, behaviors to kind of grow very quickly. And so I think there's now a lot more scrutiny around how do we provide the same kind of Web2 experience when it comes to exchanges, for instance, in the CeFi space, with a Web3 transparency, provenance, and everything that provides. And so there's a huge opportunity to create this kind of hybrid architecture around CeFi and DeFi and what that actually looks like. So again, there's some very interesting elements happening in that space, which both on the institutional side, in terms of helping institutions come into DeFi in a de-risked way, as well as on the more retail side, which is, hey, I want to trade Ethereum, BTC, and other stuff, but frankly speaking, how do I know that the next exchange I'm using isn't the next FTX, and I'm not going to have my funds locked up, or the next Mt. Gox, and I won't have my funds locked up for ages? So there is kind of hybrid architecture play too. So I think those are two very kind of big topics, and I know there's a lot to unpack there, but those are kind of two trends I'm personally looking forward to.
Okay. Anybody that you're aware of doing any of those things particularly well already, or starting to do those things, or talking about those things? Where should we be looking 2023 without shilling anything necessarily? Just anyone doing it well?
Yeah. On the Web 2.5 side, I mean, there's some very interesting companies. Moonwalk comes to, as one thing comes to mind, and Palm Network. I mean, Moonwalk, again, upgradable NFTs, where you start with NFT that has utility A and can be upgraded to utility B, C, and D as that NFT scales, which is great to see. The so and then there's a bunch of peripheral companies which are basically tying together, let's say, the content creation side with the ability to bring that on chain, and then start monetizing that on top. And so there's a couple of kind of layers to that stack, if you will. On the DeFi side, again, I mean, a lot of our viewers may have heard us, but there is, one of our projects, Spool, which is, is a DeFi middleware, connecting capital aggregators with yield generators at a base level, and doing something very interesting, which is, in its simplest form, if you have some assets to deploy as an institution, you have assets to deploy into the Web3 space. You don't just need to buy BTC and ETH as the blue chips, which are volatile and of course go up and down in value. But why don't you have almost a fixed income product, which is essentially what some of the yield, stablecoin farming in DeFi enables you to do. So whereas you can deposit USDC or DAI or USDT, you take a stable coin that is tied back to USDC value. You choose which protocols you choose to invest into. So it's the Harvest, the Curves, the Aves, the Compounds of this world. Under normal circumstances, it'd be very difficult to automatically balance, and keep track of these things. So this does it all for you. So you pick which protocols you want to invest into. And then finally picking the risk that you want to take on. So very similar to we've seen Nutmeg and robo-advisors in the Web2 space, which is around, well, I want to be super conservative, I want to be super risky, which of course, gives you a yield of between, 1 to 2 to 3% on the super low side, and, 10, 15, 20% on the high side, even without some of the degen strategies that we've seen across, across the crypto space. And again, doing it in such a way that it auto compounds, auto rebalances, and does it in a way that you don't need to hire a whole full analyst team to keep track of a 24/7 DeFi market. And at the same time, don't have to trust a black box to do the right thing for you because it's all on chain. So that's just an example of one project that we've seen, and of course we're building because we saw that problem in the market, and which we're solving as we speak. So yeah, I think there's going to be a lot of innovation in DeFi, and the great thing to see is that builders will keep building irrespective of what the Bitcoin price does or the market sentiment is, which is great to see.
Yeah. Well, okay, speaking of building, let's get back to, you mentioned earlier a previous experience with mergers and acquisitions. We see this all the time in traditional kind of finance world and startup world, the fast eating the slow and the big eating the small. Why don't we see this so much in the Web3 space? It's actually this big question mark for me. How come? I recall one merger that I can think of, and maybe a couple of almost inconsequential acquisitions, and some of it's been for talent and some of it's been for a piece of technology. But why isn't this more common in the Web3 space? What is this? For me, it seems like a massive opportunity lost where we'll see 100 projects die rather than getting eaten, or a couple of them merging and actually seeing some new life, or any of those kinds of things. What's the story?
Yeah. I think there's a couple of reasons for it. The first is that a lot of Web3 is open source. If you look at SushiSwap was a fork of Uniswap.
We'll just take it.
Just take it and build on top of it.
Yeah,
it's cheaper, right? And actually, interesting. I think we will move back to a more closed model. In some areas, because you want to protect that IP. And so if you're thinking about, okay, well, you can build commercial open source systems, and you can create a moat through network effects or through the speed of innovation. You can certainly do that. But it's a risky strategy in many respects, because we're in such a new space, and things do move very quickly. And so often, and this is part of the great things about Web3 is its composability, because you'll take what Project A has done, and Project B will take some of Project A and build on top of that, and Project C will keep doing the same and combine A, B, C, and D. And so, I think that is a key reason for it. So looking to basically fork an existing project and then build on top of it is cheaper, honestly speaking, than actually just buying it outright. Secondly, and to your point as well, I mean, some of the reasons we've seen for acquisitions is acqui-hiring, because we know that Solidity developers, Rust developers, or developers in general that know crypto are somewhat hard to come by.
Yeah.
So we've seen some of that, but again, that's been more by large institutions. Then the third thing is, what are you actually acquiring? A lot of these systems, a lot of these companies are built to be decentralized. You're not buying an equity holding of X. A lot of these projects are being built as DAOs, or a lot of these projects are being built as decentralized networks, not owned or governed, just governed by the people, if you will, rather than kind of one single entity. And so it's very difficult to acquire that without, let's say, acquiring the majority of the governance tokens, which kind of defeats the whole point of the decentralized system. So I think this idea of decentralization, democratized voting, governance, etc., is a core facet, which is why we haven't seen a lot of that. And again, the speed of innovation makes it so that borrowing different parts of what people are doing and building on top of that is at least a more profitable strategy than just acquiring something outright.
So the space is moving too fast for mergers. It's too free and decentralized for acquisitions. And possibly even some of the acquisitions that have happened, like I know, I'm not sure how publicized or even how public these are, but I'm aware of one exchange who purchased an NFT platform for a ridiculous sum of money, then took so long to actually roll it out that it's basically useless and unused. And so, like the speed of innovation being too fast, perhaps, and too decentralized, like you said. That's interesting. I hadn't actually really considered it like that. And obviously the freeness of open source things, you can just fork something, tweak it, make it do what you want it to do, or build on top of. Interesting. Is there a space for M&A in the Web3 ecosystem? And if so, where is it?
I think there is.
Outside of acqui-hires, like you said.
Yeah, I think there is. I think there is definitely space in things like exchanges, for instance, of course. So basically more centralized entities, which are which provide and look, it really depends on what's the reason why you're looking to acquire something, right? So you're looking either to acquire a company to extend into a new market, to diversify your offering, to kill a competitor, like we've seen Google do for many years now. Any DeepMind, a lot of these companies which have started getting traction, subsequently get acquired very quickly. ChatGPT by Microsoft. We see this all the time. So I think there will definitely be that, but I think it will be either if regulation allows, maybe some of the incumbents in the Web 2 space trying to buy some of the big guys in the Web 3 space as a way to diversify into Web 3 without fully understanding it. Or it will be some of the Web 3 giants. And by Web 3, I mean things like kind of Coinbase or Binance or some of these guys looking to acquire smaller players that will enable them to either extend their offering or that potentially pose a threat to their business model and follow a similar blueprint to what Google and some of the tech giants have been doing, in the past. So, and the final thing is, I think we will see kind of more innovative M&A style deals, which is around more kind of collaboration, where let's say one DAO buys another DAO's governance tokens, and again we've seen. And again, this is a slightly different example, but Curve and Convex, right, where you have these kind of bribing properties of governance tokens, and I think there will be interesting governance token based acquisitions. How those play out and how those work in practice, I think we're still yet to see.
Interesting, yeah, man, that would be a super play. I'm looking forward to. I'm not aware of any of those having happened yet, like a hostile takeover of a DAO by just acquiring the governance tokens. That's an interesting play.
I haven't, no, either. But also, if you think about when you acquire a company, you're thinking about, okay, well, DAOs have treasuries. Those DAO governance tokens govern those treasuries. So if a treasury, is, let's say, 20 million, but the cost of acquiring a majority stake is, let's say, 10 million or whatever that might be, right?
Yeah.
Sadly, we might see some of the good old fashioned kind of robber baron style activity that we saw back in the 80s and 90s, right? In the LBO days. And again, that's the more cynical view of it. But I think,
Yeah. I can think of a
as the
couple of those
markets
actually.
becomes more mature. Sorry?
I can think of a couple of those actually right now. I never thought of that
Exactly.
strategy. Far out. That's a shocker.
Yeah. It's gonna be interesting. I mean, what's on your radar? Have you seen any kind of um, sort of any of these murmurings, any of these kind of plays coming out?
No, I genuinely had not thought of it in that kind of sense before. But
Mm.
even just as I'm thinking about it now, yeah, man, a couple of kind of strategies come to mind.
Yeah, and again, this
Yeah.
this is this is this is the funny thing. We think there's and there is a ton of innovation in Web3. There's no doubt about it. But at the same time, we don't need to completely throw the playbook out the window for everything that's happened before. Whether it's around governance models or whether it's around the financial plays, let's call them, around how acquisitions and mergers and LBOs, leverage buyouts that we've seen in the past. So I think, yeah, a lot of these strategies will become more and more kind of adopted in the crypto space, but with their own kind of spin, if you will, because we've
Yeah.
got a few new tools and to play with.
Yeah, I mean, it's coming back to the traditional finance, like what's the price to book ratio, and exactly as you say, if
Mm.
they're sitting on 20 mil in the bank, as it were, but the valuation of all of the tokens is 10 mil, you can buy it and double your. You don't even need to buy it; you just buy a controlling share and make a buttload of money. But yeah, I guess you might kill the project in the process. So
Yeah.
yeah, so there just many more things to think about for sure, man. Yeah, I'm not sure where to take that without kind of chasing down a more destructive path. So I do want to ask you one more question before we head off. Easy money era is gone. There's still money out there. People are still looking to invest. There are still people who are building really great projects. From my perspective, the bear market is the builder's market. This is the time to be building. There are phenomenal opportunities. There are new technologies, coming out. People are integrating artificial intelligence and machine learning and LLMs into their projects and roadmaps and things like this. What's your advice to people, founders in particular, or people who are building right now, or people who are thinking, "Oh man, I've got to wait for the next bull market to build because there's no money or no opportunities"? What's your advice to people building now, or people who should be building now?
Yeah. Um, Look, I think it is. I think the greatest value is created in a bear market. That's the truth of it, because the again, it goes back to problem solution set. The biggest advice I give to founders is that avoid the super hype waves. I mean, it could be a real draw, and to do a project and insert buzzword A, B, C, D, E to kind of to raise capital and do it. And look, I mean, we've seen this happen time and time again. And there is, on the one hand, nothing wrong about surfing the hype waves in some respects, but it's also the difference comes is when it detracts from your core vision of where you're trying to get to. And if you're saying I'm an AI based project, blockchain project, using NFTs in the metaverse to integrate with DeFi, and I don't know how many more buzzwords you can insert in there. Okay, well, I think most investors will look past those hype and the buzz. At least they should, and more sophisticated investors will. And they will look into, okay, great. So what we're doing is, what is novel about this? What is defensibility? How would you go to market? And really kind of what are you trying to build here? And when we invest, we look at it as a 2, 3, 4, 5 year time horizon. For sure, you're looking at projects that you're willing to hold through bull and bear. So founders coming into this today and now in what is still a bear market despite the little bull rally we've had recently, is focus on building a product and a solution that solves your core market's needs. Make sure you're building to scale. Make sure you are continuously testing, getting user feedback. Make sure that you are following all the lean principles that we've learned from web 2, but at the same time, play with the tools that you have in Web3, right? So yes, of course, you could do better equity in token. Just if you do it in the right way, you can definitely raise capital and attract different user groups and create new revenue streams, both in the short term and the long term. Maybe NFT drop is a viable thing for you, and makes sense. But again, don't just see it as a one-time thing, but see it as a content or product play. So I think you know definitely focus on these startup principles, focus on product market fit, use Web3 tools at your disposal, reach out for advice and learn from other projects, because the great thing about crypto is everyone learns, everyone's very transparent. You can see what works and what doesn't. And just focus on building something that people care about. And I can promise you that when the bull market comes around, the products that have done a great job in doing that, will get a huge amount of hype and a huge amount of traction, because people will pick up on the fundamentals sooner or later. That's my 2 cents. But I'm curious to hear your thoughts on this, Don. Actually, what's your kind of take on this? For the next, if you're building a project right now, in the depths of the bear market with an unknown future, because we've seen what's going on in macro, and that's a whole separate kettle of fish. But if you're building a project for the next sort of 3-4 years, like what would you be doing and saying to other folks?
Well, in terms of opportunity, I think exactly as you said, in a generic sense, there are massive problems to solve and very small niche problems that need solving, that are just great opportunities for companies in general, and specifically things that blockchain can advance or help or solve in a unique kind of way, especially when you're interacting with Web 2 or interacting with AI, or having a combination of these kinds of things. So there's heaps of space there. I think that NFTs have been way underserviced or underrepresented, should I say, by the PFP craze, and basically the hype of 2021 has made people, kind of inoculated people a little bit to the potential of NFTs to solve some really great problems. And so some of the things that I'm most excited about at the moment are projects that are using non-fungible tokens to actually solve real world problems. And I know that there's, we mentioned them you mentioned a couple of them earlier today, even things like in the, like for Web 2 companies coming into Web 3 who are using NFTs as content marketing or loyalty programs or things like this. But for me, I think the plays that are kind of replicating brick and mortar unit trusts in a way that can be kind of democratized across the globe and to people who don't have access to real world assets as they stand now, man, there's just great opportunity in that space as well. And some of the projects I'm most excited about are actually doing things in that kind of arena. And some super boring, non-sexy things as well, where people are using NFTs and fungible tokens as well in a way that'll be totally transparent to the end user and even the end investor, but are utilizing blockchain, I think, in that infrastructure kind of sense. Man, there's some great opportunity there as well. And in a certain sense, I'm glad that some of the hype for blockchain has died down and moved over to AI, because, the stupid money is now over there. But I'm glad that people are still building in blockchain and even integrating AI as well, and LLMs and machine learning into their projects and plays, because, man, there's just great opportunity in those areas too. So that's what I'm most excited about. The non-sexy stuff that's actually going to make a big difference in the world. And I don't say that in a naive kind of sense. I mean, it's going to make a lot of money as well, but it's going to help a lot of people and solve a lot of problems.
What I'm really looking forward to is I'm looking forward to the time when we stop using the words NFT, right? And we just talk about the end product. It's like when you and I talk about a car, we're not going to say, hey man, did you check out the spark plug on that one? It was like a really good spark plug. And did you see the engine there? We talk about, it's a good looking car. It's got a V6 or V8, right? It's got, it drives like, etc. We don't, you don't need to know how the internal combustion engine of a car works to get from A to B. And then there'll be some enthusiasts who are very passionate about the under the bonnet stuff, but the majority of the users, they just want to have a good user experience. In the same way that you go on Instagram, you don't care about how AI algorithm works. You just want to see the next relevant picture, or you go on Amazon, you want to see the next relevant product. And it's the same thing. And I'd love to see, I think exactly to your point, I'd love to see some proper application and use cases where a lot of the tools that fundamental blockchain is it's kind of just abstracted away into kind of back under the bonnet, and then on the surface we see the stuff that consumers really care about.
Yeah, man, I was advising a company even just yesterday who were trying to come up with a name for a particular, in fact, a new company, a new business unit, new company within the company, and they wanted to call it NFT something. I'm like, get NFT out of the name, make it as transparently NFT as possible, because the people might be scared off by NFT. They think, oh, NFT, that's that stupid craze, or that's just people's profile pics and things like that. Whereas actually, you're potentially scaring off both users and investors by having NFT so upfront. Whereas NFT is exactly as you say, it's under the bonnet. It's almost transparently utilized in the product itself. So don't even call it that. Just solve the person's problem and show them how you're going to do it.
Yeah. It's such a boring answer. I think this is the funny thing. It's such a boring answer people don't want to hear, because I'd rather draw a very pretty diagram of how your NFT goes from A to B to C to D to D to E. When you need to, you just don't need to. So waiting for a simpler life, that's for sure.
Good on you. Yaro, thanks heaps for joining us today. Really, really appreciate it. All the best. Gonna have you back on, hopefully, in the near future as well. Talk more about some of the things we've really just scratched the surface on today. Good on you.
Love it. Thanks for having me, Don. Great to be here.
Thanks for joining us today. Hope you've enjoyed this episode of the Off-Chain Podcast. Thank you to our co-host Yaro today for joining us. We love bringing you great guests, and we hope we've inspired you to learn more about Web3 and technology as we're thinking about what the future might hold and how we might build it together. As always, please like, subscribe, or even share with a friend something that has inspired you or helped you from today's episode, and join us again next week for another exciting episode of Off-Chain. Take care.